If you're self-employed in Canada, freelancer, consultant, contractor, side hustle, small business owner, you're probably paying more tax than you need to. Potentially, a lot more. Incorporating your business is one of the most powerful tax strategies available to Canadians. It's not just for large companies. Many people incorporate with as little as $50,000 to $100,000 in annual business income, and the tax savings can be significant enough to pay for itself many times over. Today, we're covering how it works, when it makes sense, and what the actual numbers look like. When you earn self-employment income as a sole proprietor, the default for most freelancers and side hustlers, that income is added directly to your personal taxable income and taxed at your full marginal rate. If you're in Ontario earning $120,000 total, your marginal rate on business income is around 43%. Every dollar of profit is taxed heavily. A Canadian-controlled private corporation, a CCPC, which is the standard incorporation structure for small businesses in Canada, is taxed completely differently. On the first $500,000 of active business income, a CCPC qualifies for the small business deduction, which brings the combined federal and provincial tax rate down to roughly 12 to 13%, depending on your province. That's the core opportunity. Your corporation earns $100,000 in profit and pays roughly $12,000 to $13,000 in corporate tax, leaving $87,000 to $88,000 inside the corporation. As a sole proprietor in a high bracket, that same $100,000 might trigger $40,000 or more in personal tax. The money left inside the corporation can be reinvested, used to pay business expenses, or eventually distributed to you, on your timeline, in the most tax-efficient way possible. The biggest advantage of incorporation isn't elimination of tax, it's deferral. And deferral, as mentioned in a previous video, is enormously powerful when compounding is involved. Here's how it works. Your corporation earns $150,000. You only need $80,000 personally to cover your living expenses. You pay yourself $80,000 as salary or dividends, which is taxed personally at your marginal rate. The remaining $70,000 stays in the corporation, pays the low corporate tax rate, and can be invested inside the corporation, growing in a lower tax environment for years before you ever touch it personally. You're deferring personal tax on that $70,000 until you eventually draw it out. Ideally, in a lower income year, in retirement, or through a strategy that minimizes the personal tax on withdrawal. The longer the money stays inside the corporation compounding at a lower tax rate, the more powerful the deferral becomes. This is why incorporation becomes increasingly attractive as business income grows. The more income you earn beyond what you need to live on, the larger the pool of money benefiting from the lower corporate rate. Incorporation isn't free and isn't right for everyone. Here's an honest look at the trade-offs. Incorporation costs roughly $1,000 to $2,000 in legal fees to set up, plus annual accounting costs of $2,000 to $5,000 or more for corporate tax returns and bookkeeping. These costs are real and need to be weighed against the tax savings. At low income levels, the savings don't justify the overhead. A common rule of thumb: incorporation starts making financial sense when your net business income, after business expenses, consistently exceeds $50,000 to $60,000 per year, and you don't need to draw all of it personally. If you're earning $80,000 in business income but spending all of it on living expenses, the deferral advantage disappears, and incorporation may not be worth the administrative cost. There are other advantages worth knowing about. The lifetime capital gains exemption, currently over $1,000, allows qualifying small business owners to sell their corporation's shares largely tax-free. Income splitting with a spouse or family members as shareholders can reduce the overall family tax burden. And certain business expenses, a home office, vehicle use, equipment, professional development, can be deducted at the corporate level. The complexity of corporate tax planning is also why this is one area where professional advice pays for itself. A good accountant familiar with small business taxation in Canada can structure your corporation in a way that maximizes these benefits legally and cleanly. If you're self-employed or earning meaningful side income in Canada, incorporation is worth understanding even if you're not ready to act on it yet. Knowing how the system works lets you plan for the point when it does make sense. The short version: once your net business income consistently exceeds $50,000 to $60,000 and you don't need all of it personally, talk to a Canadian accountant who specializes in small business. The tax savings in many cases are significant enough to be genuinely life-changing over a career. Next week, we're covering something that affects millions of Canadians: side hustles and self-employment income, and specifically how to handle the taxes on it correctly so you don't end up with a surprise bill at tax time. Subscribe, and I'll see you there. See you then.